For over 100 years, the Fed has been in charge of the US money system. But let's be honest, it hasn't always done a perfect job. Making things more confusing, it has a weird setup that's hard for regular folks to get. That's why some people have come up with strange ideas, like saying the Fed is owned by rich families or even run by lizard people. Today, let's go back to when American money first started and find out how the Fed was made, how it does its job, and who really owns it. In the late 1800s, America had some serious problems. The Civil War was tough, but even after it ended, the country kept having big money troubles. The main issue was that America didn't have a good money system, and most importantly, it didn't have one central bank to help out when things got rough. Now, central banks weren't a new thing. The Dutch made the first one in 1609, and it really helped their country become a big deal. Following that, the English created the Bank of England in 1694, which became super important for the British Empire. But here's the catch. Because the Bank of England was linked to the British, the people who started the United States didn't want to copy that model. There were a couple of tries at making a central bank, even when people didn't like the idea. Alexander Hamilton led the first try in 1791, but both times, these systems didn't stick around for long, and they didn't fix the problems. The situation was bad back then. If one local bank failed, it could set off a panic across the whole country. People knew that if their bank was in trouble, nobody could save it. So as soon as they heard their bank might be in trouble, everyone rushed to take out their money. This caused even healthy banks to go broke because everyone was scared. Bank failures and economic downturns happened a lot. American bankers like Paul Warburg in 1907 knew their industry was in bad shape. Just a few months after Warburg warned everyone, the panic of 1907 hit, and it was really bad. An earthquake in 1906 wrecked 80% of San Francisco, making it tough to rebuild. One banker tried to cheat the system by messing with a company's stock on Wall Street. Instead of making money, the plan backfired, and the whole stock market crashed. This guy was connected to 10 different banks, and as people panicked, these banks failed one after another. Even banks not connected to him went under because people were scared and withdrew all their money. In times of trouble, everyone turned to J.P. Morgan, the king of Wall Street back then. In October 1907, Morgan gathered the big bankers at his office and used their combined money to save healthy banks that were close to bankruptcy because people were scared for no good reason. Something similar happened in 2008, but that time the government stepped in. In 1907, it was all thanks to private individuals like J.P. Morgan. After the panic settled, everyone realized they needed a central bank. Congress quickly passed a law to make one, but agreeing on how it should work was tough, and it took over 5 years of arguing to figure it out. The southern states were worried a powerful central bank would give too much power to Washington and Wall Street. Bankers wanted to make sure the central bank wouldn't be controlled by politicians and wanted it to be as separate from Washington as possible. The negotiations weren't happening in the usual places in Washington, though. They were held 600 miles south on Jekyll Island in Georgia. A private club of over 100 rich guys, including John Morgan, met there. Only a few actually helped plan the central bank, and it wasn't until 1913 that Congress finally made it happen. The new Federal Reserve was a result of a lot of compromises. The United States Federal Reserve, colloquially known as the Fed, stands as a stalwart guardian overseeing the intricate web of the nation's financial and monetary systems. Its multifaceted operations and policies wield considerable influence over the economic well-being of the country making it imperative to delve deeper into the workings of this complex institution. At its organizational core, the Federal Reserve boasts a distinctive structure featuring 12 regional banks strategically positioned across the United States. These regional banks, while possessing a degree of autonomy, collectively contribute to the formulation of monetary policy through the Federal Open Market Committee, FOMC. The FOMC, composed of representatives from these regional banks and the Board of Governors, serves as the key decision-making body, steering policies related to interest rates and the money supply. These regional banks play a crucial role in implementing monetary policy, regulating and supervising financial institutions within their jurisdictions, and contributing to the decision-making process of the Federal Open Market Committee, FOMC. A pivotal responsibility of the Fed is the regulation and supervision of banks, ensuring the stability and integrity of the financial sector. The Fed establishes and enforces rules and guidelines for banks, working diligently to prevent disruptions and maintain the overall health of the banking industry. The Federal Reserve actively manages the money supply, employing various tools to influence interest rates and control the amount of money circulating in the economy. Among these tools is the implementation of reserve requirements, mandating that banks keep a specified percentage of their deposits as reserves. This mechanism aids in regulating the lending capacity of banks and consequently influences the broader economy. Imagine a scenario where the economy is experiencing rapid growth and consumer spending is on the rise. In response to this economic expansion, the Federal Reserve may decide to implement a tightening monetary policy to prevent the economy from overheating. One of the tools it can employ is adjusting reserve requirements for banks. Let's say the Fed decides to increase the reserve requirement from 5% to 10%. This means that banks are now required to keep a higher percentage of their deposits in reserve, reducing the amount of money they can lend to consumers and businesses. As a result, banks find themselves with less available funds for lending. This translates into higher interest rates for borrowers, making loans more expensive. With increased borrowing costs, consumers and businesses may become more cautious about taking out loans for purchases or investments. The higher interest rates act as a deterrent, slowing down spending and investment in the economy. By adjusting reserve requirements, the Federal Reserve effectively influences the lending capacity of banks, which in turn has a ripple effect on the broader economy. This strategic move helps the Fed manage the money supply, control inflationary pressures, and maintain overall economic stability. During periods of financial turbulence, the Federal Reserve assumes the role of a lender of last resort, providing financial institutions with loans to avert systemic collapse. This function was notably evident during the 2008 financial crisis, where the Fed played a crucial role in stabilizing the economy. Another integral aspect of the Fed's operations is its participation in open market operations. Through the buying and selling of government securities, the Fed can influence the money supply and interest rates, further fine-tuning economic conditions. The dual mandate of the Federal Reserve emphasizes its commitment to promoting maximum employment and stable prices. Striking a delicate balance, the Fed endeavors to keep inflation in check while fostering conditions conducive to full employment. These efforts underscore its dedication to the economic well-being of the nation. In collaboration with the U.S. Department of the Treasury, the Federal Reserve manages the government's bank accounts and plays a central role in the issuance of government debt. This collaboration ensures the coordination of monetary and fiscal policies, reinforcing the Fed's influence in the broader financial landscape. Communication is a cornerstone of the Fed's operations, promoting transparency and accountability. Regular public announcements, detailed reports, and press conferences serve to keep the public and financial markets informed about the central bank's decisions and outlook. While subject to oversight by Congress, the Federal Reserve operates with a degree of independence to insulate its decision-making from short-term political pressures. This independence allows the Fed to make decisions based on long-term economic considerations rather than immediate political considerations. Let's imagine a scenario where there's a sudden surge in inflation, and politicians are urging the Federal Reserve to lower interest rates drastically to stimulate the economy before an upcoming election. Despite the political pressure, the Federal Reserve, operating independently, carefully weighs the long-term consequences of such a move on inflation, employment, and economic stability. The central bank resists the immediate political demands, choosing a measured approach that aligns with its commitment to long-term economic well-being rather than short-term political gains. The United States Federal Reserve, established over a century ago, plays a crucial role in safeguarding the nation's financial stability. Despite occasional imperfections, the Fed's intricate structure, formed through compromises and negotiations, features 12 regional banks strategically positioned across the country. The Fed actively regulates the banking industry, manages the money supply to influence economic conditions, and operates with a dual mandate focusing on maximum employment and stable prices. Collaboration with the Treasury, transparent communication, and independence from short-term political pressures underscore the Fed's multifaceted impact on the nation's economic well-being. In essence, the Federal Reserve serves as a dynamic steward of economic stability, adapting and responding to ensure the resilience and prosperity of the United States economy. Hello, my friends. You've reached the end of the video, and I want to express my sincere gratitude for sticking around until the conclusion. Your support means the world to me, and I genuinely appreciate your time and engagement. If you enjoyed the video, don't hesitate to show it some love by hitting the like button. I value your feedback, so please drop a comment below letting me know your thoughts. My channel focuses on producing entertaining documentary-style videos covering topics related to business, finance, and life in general. If that aligns with your interests, consider subscribing and ringing the notification bell to stay updated on future content. Thank you again for being part of this journey, and I hope you have a fantastic rest of the day. See you in the next video. Join us in the upcoming video where we uncover actionable tips and strategies on turning economic downturns into opportunities. Don't miss out on how to profit during a recession, your guide to thriving in uncertain times.